Hello, everyone. Thank you so much for joining us today for our free webinar, Ask the VC, Raising Venture Capital, with Sean Foote from CoCreation Capital and Gadiel Morantes from Early Growth Financial Services. I am Erica Malsberg. I'm the Chief Marketing Officer for Early Growth Financial Services, and I'm going to be your moderator today. For those of you who have joined previous webinars in our series, this one's going to be a little bit different from our usual format. We really want to open up the floor to all of you in the audience to give you an opportunity to ask your questions, whatever questions you have for the venture community. So we're giving you 3 ways to ask your questions. One, on your dashboard, you should see a little hand icon. So that's to raise your hand. So if you want to raise your hand, just click on that icon and I'll see that you've raised your hand, and then I'm going to unmute you so that you can actually speak and we can hear you, and then you can just ask your questions to Sean and Gadiel. If you don't feel like speaking, but you have a question, you can still just use the question field to just enter in your chat question, and I'll just read them out to Sean and Gadiel. And then the third way you can ask questions is to tweet them to us at EarlyGrowthFS with the hashtag AskTheVC, and we're monitoring that as well, and so we'll be responding to those. We have some content that we can go through also, but we really want to focus on you. Answering your questions is our priority in this hour. So really just jump right in with them. And just to let you know, we will be sending out a follow-up email tomorrow that's going to have a link to this deck and the recording. So if there is content in this deck, that we think you might find useful, but we don't get a chance to go through, you'll have that as a reference to check out tomorrow when we send it. So before we dig in with your questions, and I already see hands being raised, so that's awesome, I just wanted to take a moment to introduce our panelists. So first we have with us today Sean Foote. Sean is a venture capitalist, investor, and co-founder of CoCreation Capital. He was a VC with VC Labrador Ventures, which invested in Hotmail, Pandora, and Rocket Fuel. He's a professor at UC Berkeley Haas School of Business. He co-founded Village Capital and Tonic, and he was a manager at BCG and an engineer at AT&T Bell Labs. So good afternoon and welcome to you, Sean.
Good to be here.
Great.
Good to be here in my own place. Right?
Great. And we also have with us today Gadiel Morantes, who's our Chief Revenue Officer at Early Growth Financial Services. So Gadiel's an accomplished executive with 15 plus years experience. His vast experience working with founders and as an entrepreneur himself has given him great insights into what it takes to build successful companies. So hello and welcome to you, Gadiel.
Thanks, Erica.
Sure. So
he's got a beautiful head of hair. Let's be clear. You can see that. I mean, here, look at the difference.
So before we jump in, and while we're admiring Gadiel's thick head of hair, Sean, do you want to say a few words about CoCreation Capital and also about Cosmopolitan Capital?
Yeah, sure. And also I think about the day-to-day. I'm glad people are raising their hands because, we thought about, it's like you have so many ways of spending your time by listening to other people tell you what you should think. And what they think the agenda should be. And really what we wanted to try to do today is use people's specific questions, maybe even about their specific issues, to, one, answer those specific questions, then also to maybe draw some generalities for other people who are listening along. Okay, so CoCreation Capital and Cosmopolitan Capital, I'm weird because I'm a general partner in 2 funds that have 2 different focuses. CoCreation Capital is a pre-A investment fund. It invests, in those early stages, and we also are incredibly hands-on. So my partner has founded, I think, 12 companies. I invested in 6 of those companies. If you take money from CoCreation Capital, you also end up getting executive help. All VCs say they help, but we, in fact, sit in the staff meeting and take action items and do stuff. Cosmopolitan Capital is a later fund. It's a Series B, Series C fund. And it is unique in the sense that it has some very, very interesting high net worth families as its investors. So there's increasing number of strategic relationships from those investors depending on what the company does. So that's what those 2 funds do.
Awesome, thanks.
Gadiel,
yeah.
Tell us about Early Growth.
Sure, Sean. Well, Early Growth is an outsourced accounting firm, so we work with a lot of early stage companies and mid-sized businesses, but have a particular interest and expertise in and around tech companies. We started here in Silicon Valley a little over 7 years ago, and now have expanded on a national platform where we have folks on the ground in LA, New York, Chicago, Boulder, Austin, Seattle, and obviously San Francisco Bay Area. And we focus on 4 key areas: tax return preparation, filing, tax consulting, 409A valuations, and then the core business being the day-to-day transactional accounting on an outsourced basis, along with our CFO consulting services. And so that's us. I run the business development team, and we've got a staff of growing CFOs and senior accountants that do all the day-to-day work. So we just brought on a couple of new CFOs, so we're up to, I want to say, 28 folks on the CFO side.
Awesome, thanks. So I'm gonna flip over to here. So Sean, you can kind of walk through the agenda, and I want you to know I included that picture of the horse's mouth for you because Sean really likes this image of getting this information straight from the horse's mouth. So you know, I'll let you take it away here, Sean, and then people, you know, if you have questions, we'll ask them, and if not, we'll just kind of move through some of this content.
Yeah, I do like this picture because I'm not sure whether that's a horse or a mule, so it's, you know, straight from the ass or, you know, what it might be. Oh, this is being recorded. Fantastic. I'm in such trouble already. You're going to have to edit me out. I think we should go straight to, you said some people have raised their hands already. I mean, let's see what are on people's minds when you have, you know, burning questions. And then, you know, if there's things that we feel like we should talk about, we'll do it that way.
Sure. So some of the hands have gone down. I'm not sure if we already scared people. But someone typed in one question, so I'm not going to give them voice, but I will give voice to the question. Anne wants to know if it, like, how involved do VCs really want to get in your company, or do they just want to see the return on their investment?
That's a great question. I think it's the case that if you raise your hand and we click on you, you actually get to ask the question interactively, right? So we get audio that way.
Yeah, okay, if people want to, but you know, just I don't know, in case people are not wanting to, that they still can enter in the question. So yeah, just enter that
in. Great, because you know, lots of times there's follow-up questions. Here's my sense. I mean, I already said that we get really involved. My sense is that if you went to 10 venture capital websites, they all say how they help companies. And I'm talking about traditional VC. I think there's also incubators and things like that, which are a slightly different model. But if I start with VCs, we all say we help. And really what that typically means is we sit on the board and we talk once a month, and maybe we call you on the phone a little bit between that. We try very hard not to pay any attention to you unless there's a problem. And then when there's a problem, we really spend a lot of time. And if you ask me for help on, say, hiring a VP of sales and stuff like that, then I'll get very focused in that. But the challenge for most VCs, and I've been on that model for 15 years, is you just don't have a lot of time. It's like I did a timesheet of how I spent my time when I was in the venture business, and I only spent 25% of my time with the portfolio companies, and there's 6 companies. So that basically works out to I spend 1 day a week working on any particular portfolio company. So the venture capital industry is not really structured to be super duper helpful, except episodically when there's some very particular issue that needs help. And so we all say we help. The fact of the matter is we don't actually help that much. I think from your perspective, that's probably the way you want it as well, which is you only really want our help when you ask for it. Otherwise, we think we're helping, but we're actually just generating a lot of additional overhead for you. Incubators are different. Incubators also say they help, but it's more programmatic. It's like, welcome to the beginning of our program, and by the end of the program, we then don't want to spend any more time with you because we will be working with the next 40 companies that come along. Incubators have a wide range of feedback. You can get that from lots of different places. There are a few where the entrepreneurs I talk to say those incubators were incredibly helpful. There are many more where they're not actually that helpful. And so I think you shop for an incubator the same way you would shop for a VC or an employee. You know, is this really going to help me? So I hope that answers the question, Anne. If it doesn't, follow up.
Great. And we have a question here from Amir. So I'm gonna check and see if this works. I am unmuting you, Amir. So you should be able to speak to Sean and Gadiel now. Can we hear you?
Yes. Hi, everyone. Okay, good.
Great.
Okay, so I have a startup We launched our app about 2 weeks ago, and within 2 weeks, we got some users and some vendors on our platform. The challenge that I have is how much money should I raise? This is my biggest challenge. So I was wondering if you guys could help out, guide me to the right direction.
How much money do you need?
Got it. This is the thing. So the more money we spend on the marketing, I can see that the faster we can grow.
Right. Okay.
So
Yeah. Yeah. So it's a variable number. Let me give some thoughts, and then I'm sure Gadiel has some thoughts too. But my first question of how much do you need is like the single most important thing. So I have companies that show up, and they have a spreadsheet of their next 3-4 years. And like for now until infinity, they only need $2 million, but they're asking for 5, right? And so the reason why they're asking for 5 is they can't get a meeting with a venture capitalist if they're not asking for 5, because everybody's appetite is bigger than what they really need. So there's one answer, which is you ask for what the people that you're asking for money typically provide. So if you're talking to, let's say, the Band of Angels, which is a group of angels, you ask for $1 million or less, because their appetite is typically about $700K. If you're talking to my early fund, you're also in that range. But if you're talking to my later fund, you're asking for 5. So there's a little bit of matching how much you say you need with who the audience is. But so that's one answer to the question. The other answer to the question is it turns out that acquisition costs do not scale. And so if you have a model that says I can acquire a paying user for $3 and they pay me $10, and therefore if I have $300,000, I can get $1 million worth of revenue. Typically, it doesn't scale that way. So there is a whatever you were using to acquire users, that pipeline starts to exhaust or become more expensive, and you kind of need to know where that is. I think that if you've just launched 2 weeks ago and you have some users, I think the other rule of thumb is based on that stage, you're raising less than $1 million and more than 100,000. It's kind of a big ballpark, but you're definitely not raising $3 million for an app that's just launched, unless somebody shows up and says they'd like to give it to you.
got it.
Is that helpful?
Yes.
How much do you want to raise?
I was thinking about $250,000.
Okay. And what does that do? What does a company look like after you've spent $250,000?
They're focusing more on marketing side and trying different channels. That's what I would try.
Right. Yeah. So the reason why I asked the additional question, and again, I'm kind of using these questions to illustrate to people who maybe aren't asking questions. Mm-hmm. The reason why I asked those questions is, as an investor in equity, if I were to invest $250,000 in you, it is worth absolutely zero to me until your company gets some sort of exit. And if you're a money-losing company, you have to raise more than that $250K to keep going to get to an exit. So really what I'm asking is, when we go out to raise money again, or if we need to sell the company, what do you look like? How many users do you have? How much revenue do you have? How many employees do you have? And is that something that looks fundable, or is that something that looks acquirable to me as an investor? And so I think that the answer to that is crucial to helping investors know how they're managing risk and how they're going to get to an exit.
Got it.
Gadiel, you want to add anything?
And that's where areas like, and I was going to chime in and just say, and that's where areas like building a financial model or figuring out what your 3-year or 5-year projections can come into play. And that also gives you a framework and an idea of how much we need to raise, how much we should be raising. And then, Sean, to your point, like, are you targeting the right folks? So if you're talking about 250, do you call that more of a friends and family round and go in for that type of capital versus going straight to, VCs like yourself too, right?
Yeah, and 250K in this market is a convertible debt raise, which is nice. You can do a rolling close. You don't really have to set a valuation. If it's 2 million, then you're kind of in the range where you're starting to think about a formal round of financing, which brings with it additional oversight and additional paperwork. You're talking about the financial plan, Gadiel. I have this joke that says if you build a 5-year financial plan and you're showing it to a venture capitalist, it's different than an incubator or an angel. But if you're showing it to a venture capitalist, the 5-year revenue number better be between $50 million and $100 million. And the reason is because if it's more than $100 million, we don't believe you because it's way too inflated. And if it's less than $50 million, we think it's too small. And so you should consider that when you're thinking about whether you are a VC qualifiable business. I think there's incredibly good businesses where you will make a lot of money as a founder that don't have to become $50 million businesses, but you really have to figure out how you're going to sell your $5 million revenue business to somebody at a profit.
Got it.
Awesome, thanks.
Thank you much.
Sure, I'm gonna go ahead and mute Amir again. Others, if you have questions, raise your hand. Right now we have one question that was entered in, and let me see if I can read this out here. It's from, I'm sorry if I mispronounce your name, and feel free to raise your hand so you can correct me. It's from Varun, and Varun wants to, his question says, understanding very well that there are no typical or average metrics, can you please shed some light on what are the typical metrics one needs to target as a startup CEO for pitching to Series A investors? He's heard ballparks like 50K monthly active users growing at least 5% per month or something like that. Do you have any guidance in terms of metrics?
Nope. Next question. No, I mean, you know, we'll make something up, but, you know, that first point is that every company is different. So like the example you gave of monthly recurring revenue is relevant to certain types of businesses and not others. So let's talk from analogy just from the companies that I've been looking at in the last, you know, month or two. There's one company that has absolutely zero revenue, but they have a negotiated strategic relationship which should lead to lots and lots of revenue, but it hasn't yet led to anything. But at least they got the deal done. And you know, that's a perfectly reasonable position for that company to be in. They're not a consumer-facing company, and so it's easier to, I think, raise money for a business-to-business thing on the backs of a good channel or a good strategic relationship, even if you have no revenue yet. I think that since for mobile apps, and I have to bias a little bit as a venture investor, I'm incredibly bearish. I'm not that excited about mobile apps, mainly because it's really hard to scale them. It's, you know, finding an audience for a mobile app that can absorb, you know, $5 million worth of venture capital. To absorb $5 million worth of venture capital, you're going to have to grow to be a $50 million, $100 million exit, and that's really hard for an app. So, but if you're raising $500,000 and you have several $100,000 in annualized revenue, I think that's fine, right? I mean, I think you can raise money on that, but it's really hard to say. So maybe if you could either be via audio or by typing, what kind of company are you talking about, and maybe we can be more specific. That might be interesting.
Okay, he's asking another question. Hold on.
Oh,
he says he's just, yeah, he's into typing, not talking. Fair enough. He says mobile app focused on consumers. Varun, do you want to tell us what kind of mobile app, or?
Yeah, and I can talk to that while you're typing.
Okay.
So it's really interesting. Most of the mobile apps I see, and plenty of them don't have any revenue model associated with them at all, and they can get funded. But typically what I see is there's a threshold at about 100,000 users. Apps get launched, they get a ton of downloads very quickly, things are very optimistic, and then it tails off. I looked at an app yesterday. In the first 3 days, they had 100,000 active users, and by the end of the first 2 months, they were only getting about 200 new users a day, right? So there's a big blow up at the beginning, and then it was, you know, quite a long tail, and it slowed way down. And that seems to be a very common problem of how you get from the initial excitement, the initial users, to a long-term user base and long-term growth. And so I'm looking often, you know, in those companies, not at what they what they have achieved to date, but also the velocity of what they've achieved. I see a ton of companies who say our first product is now kind of, let's see, if you're watching the video, I'm trying to do this left to right. We've gotten to the flat point, but now we're introducing a new product, a whole new app, and it's going to get us on the curve again. And this is very troubling because you have to invest more and more effort just to get to each stage.
Just to jump in, Varun has given a little bit more color. He's saying consumers defined as business users, similar to what companies such as Evernote and Dropbox would be targeting. I don't know if that changes your response, but just to add a little more color there.
Great, that's helpful color. I don't think, Gadiel, does it change yours? It doesn't really change my feel. No. I'll tell you, I've been thinking recently. This is a hypothesis. This isn't really necessarily something that I've implemented. That I may be completely indifferent to what exactly a mobile app does. It could be anything from. I looked at a company that was to help women keep track of their menstrual cycle for trying to get pregnant and have kids. And I looked at another one which was tracking mileage for your car for business expenses. And two completely different businesses. But I think where they intersect and the way I should probably look at all of them is all around like a couple of key metrics: customer acquisition cost, lifetime value of a customer, and the momentum around growth in users. It's like it may be that what it does is completely irrelevant, and all that really matters is a set of very common things. It's kind of like comparing the profit margins of Apple and Cisco. I mean, they're in very different businesses. They're both tech companies, but they're very different businesses. But in the end, the stock market kind of values them based on a certain multiple of profits. And I think that looking across a lot of mobile apps, there's just 3 or 4, and I think we all know what they are. And I think most of them are around customer engagement, customer acquisition, and that everything else kind of maybe shouldn't matter. And I should only be buying based on these metrics.
Before we move on to the next question, Gadiel, do you have any thoughts for Varun about metrics?
No, I mean, I think Sean hit it all on, the nail on the head on that. I think it's a tough space, and especially as standalone apps, it's just a hard climb, and it's a crowded market, frankly. I mean, you just look on the competitors, and you mentioned Evernote, or you mentioned some of these other task management platforms, and there's a bunch out there. So there really needs to be that differentiator, and also understanding, the example about kind of that growth trajectory really resonates with me as well, from what you were describing, Sean.
Yeah. I have 2 more analogies for the mobile app world, which is back. I was investing in '99 and 2000 when the .com business sort of blew up, and at the time there's enough noise for every different .com. And really, the discussion we would first have is how are you going to get users, right? How are you going to break through the noise? And the app stores, when they first started, it was fantastic because there weren't enough apps. So, you would launch something and people would take it because that's kind of all there was. And that world's over now. I mean, it's essentially like, trying to get a, audience to your .com. That it occurred to me in the last year, only in the last year have we seen mobile apps advertising on television, just like the .coms did in the Super Bowl. And now we see mobile apps doing it, which is a clear indication of how hard it is to acquire customers in the mobile space. The area where I think there is still the ability to just kind of launch an app and have people find it is the Apple Watch, because that environment's still pretty small. I think if anybody ever invents a decent Google Glass alternative, that app space will be small. And you can try to get in right at the cusp of one of these growth marketplaces like the watch. Now, having said that, I don't think a lot of people are selling watches. I'm not looking at a lot of watch apps. I know a lot of friends who have mobile apps who are adding watch pieces to their apps, and they're incredibly hopeful that they're going to be, there in the early days, and people will grab them because they're the only alternative for what it is they do. the early results have not been that. There's just not enough watches out there for it to move the needle for those guys.
Great. Okay, so Varun says thank you very much. And we have a couple more questions here. So I'm going to move on to the next one. I have Scott here has been patiently raising his hand. So
good. Audio question. I love the audio.
Okay, so Scott, we should be able to hear you now. Can you speak?
Sounds great. You guys hear me?
Yep, we hear you.
Perfect. Appreciate your insights today, guys. So just kind of by way of background, we've got an enterprise SaaS solution, and without going into too much detail here, we're currently in customer beta trials, and we're looking at a seed stage round. And Sean, you had mentioned the VCs typically aren't getting too involved with companies from a day-to-day perspective. I'm kind of looking for somebody that is going to be able to provide us with some introductions to potential customers. So our primary targets are really in the Fortune 2000, Global 2000, high-end stratosphere of the middle market space.
Yep.
And what's your take on that? I mean, is there an ecosystem out there in the VC world that has those relationships and would be kind of willing to take us under the wing and make those introductions?
So I don't know every VC. I'd say the short answer is no. I mean, if there was another video here and it was from some of my friends in Andreessen Horowitz, they'd have a different answer, right? They'd say, we've got 100 people on staff whose job it is to add value to portfolio companies, and one of them or 5 of them talk to Fortune 2000 customers all the time, and yeah, we'll make those introductions. And I've heard anecdotally from some companies that I know that they have made a few introductions that led to incredible helpfulness for those portfolio companies. So I think it's possible. I think that I would. I think a fair bit of it is marketing. I think it's hard for VCs to deliver. I think we do a very good job of making introductions. So I can certainly get you an introduction to a certain set of customers, and I think most VCs can do that. Just over time we have those relationships. I think we can't deliver them as customers. I mean, that's up to you. I think really, if I were running a company, I think I would probably dissociate my fundraising from the introduction bit. I mean, look, basically, if you're a money-losing company and somebody offers to give you money, I mean, as long as you're not worried that they're going to somehow make your life miserable and destroy the company, you take the money, regardless of whether they're helpful or not, because money is its own kind of help. I think that I would separately, or in addition, be looking for that person that I can compensate either with stock or with some cash from that money I raised from those deadbeat VCs to help me with those introductions. So I guess the one additional statement is, when I look at my portfolio companies, on average, they've gotten far more help from people they found to make introductions than they ever did from the board members and the investors. We're good for some things. I sound like I'm really slamming venture capitalists, but I think we've got to be pragmatic. It's just we're spread really thin, and we will make the introductions, but I think there's people who can do it better.
Fair enough, thanks.
But to that point, Sean, I think it's also important that you're finding the right investors for the company, right? I mean, folks that will be your partners moving forward, and knowing that, as a VC, you're looking at these as long-term plays, especially in this marketplace, right? I mean, the typical investment is, I mean, you shared that before. We're looking at 7 years, 8 years, even 9 years in some cases at this point before there's an exit, right?
Yeah, so you got to be married for sure. Like I said, it's like you want to find a VC that you want to be married to because you're going to be married, and the VC can fire you. It's like, oh, you thought you found the company and owned 100% of it. Well, now I can fire you and take a big chunk of it away from you. And so, yeah, you definitely want somebody that if you're going to give them that gun, you actually trust them with that gun. But let me ask actually this question to you, Gadiel, because part of what you guys provide is, I mean, you have these CFOs that work with companies, and part of their job is they help with the fundraising, and you guys have a huge number of relationships. And I know that you tailor those introductions based on what you know about the VCs and you know about the companies to make the most highly possible fit. And so I guess my question for you is, since you're working with all these companies all the time, do you get the sense that the venture capitalists are really, really helping on things like, revenue generation?
Sometimes.
Yeah.
And I think it's interesting that I think it's because I mean we do have that range, right, where we've got the very early stage investors up through the Series B guys, right? So I think what we're also seeing, and I think this is just an interesting data point too, is that there's so many new funds out there that they're actively looking for ways to differentiate themselves from other funds, right? And so one of the ways that they're doing that is saying, well, I'm going to come to the table and along with my $200,000 check, these are the other ways that I can add value because I need to cut my teeth on a certain number of investments, and I realize that it's a competitive market out there. And we've talked about this before, you and I, and obviously David, about how competitive the VC landscape is. So you are trying to find these ways to differentiate yourself a little bit. I think some of the larger folks, it may be a matter of, you mentioned Andreessen, they've got their 100 folks that can actively do that for them. Whereas I think even smaller funds can be like, well, these are the key areas where I can help you with, and maybe they do, maybe they don't. I mean, I don't have that much exposure into that piece of it, whether it truly is successful, but we work hard on matching up, especially industry and size and all that kind of stuff. So a lot of VCs talk the talk, right? And so it's just a matter of figuring it out after you've taken on that investment or that partnership.
Actually, you've really you're exactly right. I mean, we are in a world right now where VC is reinventing itself. It's reinventing itself with a bunch of small funds. I mean, Sequoia is an incredibly successful firm, but they don't need to reinvent their model. It's already successful. They're an incumbent. And you have a lot of new entrants that are trying these new things. And I have run across some of those folks that I think are adding incredible value to their companies. It's much more collaborative. It's less of a financier. I mean, it's what our co-creation fund does, right? We're less of a financier and more of a, that's why it's called co-creation, right? We're in there together. So I agree. I think those new entrants are doing it. If I took the long view, that doesn't scale, and so any $20 million fund that has hopes of being a $100 million fund will not do that by the time they're a $100 million fund. It just doesn't scale. So we'll see what happens. But I'm wearing my professorial hat now. I'm thinking about the industry as a whole, which really doesn't help somebody who's trying to raise money in the next 3 months.
Yeah, and I guess that was the kind of underlying point I was trying to get to is I'm looking for investors that can add value to my company, not just someone to write a check.
I think, yeah, I think in Maslow's hierarchy, right, I guess the absolute best solution that solves the most of your pains is a person who writes a check and adds value. And so I agree. I guess all I was adding is if somebody offered to write a check and offered absolutely no value, but also did absolutely no harm, I would absolutely take that check, because without money, you're done.
Yeah, a true story.
Yeah, so.
Okay.
So I'd keep that aperture wide, right? So if you were already a portfolio company of mine and you said, well, there's this guy who's willing to write a check for the whole amount, but and he's innocuous, but absolutely not helpful, I'd say, take the check. Right?
Okay, great. Thank you so much, Scott. We have a few more questions here, so I'm going to move on to them. We have some hands raised, but we have a question typed in that I'm going to get to first here. So this is, let's see if I can open this up, sorry. Okay, so it's from Brian, and he's saying he has a company that it's a long question, so get ready. He didn't want to talk, he entered it in. So here we go. It's Brian said, I have a company that is seeing strong B2B partnerships, stronger than we expected, and this is a key to our audience acquisition strategy. Basically, they are linked to the end consumer. We are, however, seeing much slower end user adoption, which we believe will be most affected by the marketing dollars we're seeking, as well as completion of our platform build. Investors want more metrics, but it's hard to change what we have without investment. So how do we move from interest of investors to commitment of money without the traction? And Brian, feel free to raise your hand if you want to clarify or jump in there or say anything, but I'll let Sean and Gadiel start trying to respond to that.
Yeah, I think it will just be the start of a response, but I think there's at least two really general things going on here. So one is, it sounds like this business, it's not exactly the right analogy, but this is a channel sales business, right? And so we've had great job with signing up the channel, but it's hard to manage a channel and get them to get us to end customers. There's less in our control. That's the nature of the beast with channels. I think in companies that are channel sales businesses, I care about the end user sales more than I care about the channels, right? So you can say, I've signed up, let's think of a really interesting channel. I have signed up Safeway to sell my fruit, right? But if Safeway, isn't, if no fruit's being sold, then it's not that impressive that you signed up Safeway. So I think the problem is a real one, and it's just the nature of your business model. The general comment that I've heard or the number one question I think I get asked is, how do I convince a VC to say yes? Because they don't seem to want to say yes, and there's a whole set of reasons they give for not saying yes. So is there something that I can be doing to get them to say yes? I think a corollary to that is VCs have a very hard time saying no. And so anytime a VC doesn't write a check, they're saying no on a constant basis, right? And if they are not asking you for more information than what you've provided, I mean, if they are calling you saying, hey, I haven't heard from you for a day or two, they're getting interested in writing a check. I think any other behavior besides that is just tire kicking. And so if you were out selling customers, if you're selling, if you were doing direct sales of your product to customers and that was your customer's behavior, you'd put them in a certain very low probability bucket in your pipeline and manage them that way. So, and again, VCs almost always say no, and I think there's, I say no about, depending on the year, like 200 times for every time I say yes, and so my default answer is no. And I think the additional challenge that's going on right now is there's a ton of companies that have raised a little bit of money. So if you look at the seed-funded data, and all data in the venture business is crazy, but there's like 20,000 seed-backed companies in 2014, 20,000 seed-backed companies. There were about 1,200 venture-backed financings in 2014. That's not just Series A, that's all, right? So that's also the Series C of a company that previously gotten Series A financing. So the odds of, if you were financed early, getting the later round financing, just the straight odds are like 5%. And so you're going to hear a lot of no's. Okay, so I've now vamped in case there was some clarification on how to get the yes.
Yeah. So I think the clarification needs to be how to raise your hand. So Brian, I've just gone ahead and unmuted you. We should be able to hear you speak now. Are you there?
Yeah, hi, it's Brian. How are you? Thank you. Thanks for the answer and for not understanding the complete question. I appreciate that, and, as well as your time. Hey, Gadiel.
Okay, so do you want to?
That's the whole comment.
Brian, do you have any follow-up questions, or do you feel like you've gotten your answer?
No, I think you basically brought up the the right thing, which is how do we get them to say yes? How do you get any of them to say yes on such a a limited amount of opportunity there? So in some ways that answers it. I have a specific issue of we need some small investment money to sort of raise the bar on what they seem to be looking for when we talk to them, and we're just kind of caught in the middle until we can show either somebody understands the business inherently or we get the traction that we're trying to get in these next few months.
Yeah, and actually I think there's better news for that. I think it's Brian, right? Yeah,
Brian,
I think there's better news for that small incremental bit of money than raising the, getting the proof points and raising the bigger amount of money. I think that for companies that are trying to raise less than, I don't know, $200,000, $400,000, there's more opportunity and there's more money flowing in that than there ever has been before. And it's a concept sale, right? You don't even have to have things built or proven. You just have to convince people that the concept is interesting and you're the person to execute on it. And there's more organized channels than ever before for that. From Angel List to Kickstarter to, more and more angel groups, incubators. Raising that amount of money is easier than it's ever been. So I'm more optimistic about that for you, Brian.
Perfect. I appreciate that, and hopefully just some traction will kick off, and we'll have the answers ourselves if we have to.
Yeah, I mean, and in addition, you can't swing a cat without hitting an incubator in Silicon Valley that's willing to give you $50,000 to $100,000 in exchange for going through their process, whether you care about the process or not. So apply to a couple of incubators, get the money you need, and then you keep going.
Awesome, I appreciate it. Thanks, and to Gadiel and your team, you guys continue to put out great content. So thanks.
Thank you. We appreciate that. Okay, I'm going to mute you here, and I'm going to take the next question here from David. So let's see if David, you should be able to speak now. Are you still with us? David? Okay, you're unmuted, so you can talk, but you typed in a question as well, so I'm going to start reading your question.
It's like a radio show. This is great, except we haven't gotten the cranky guy from Sacramento talking about how the San Francisco Giants should trade Buster Posey.
Be careful what you ask there. Okay, okay, all right. So let me, David, I'm going to start asking your questions just so you know it's you that we're talking about. You typed in, we are developing a SaaS platform for the finance space. Where do you go for earlier stage investors in the FinTech space? So Sean, Gadiel, to you, and then David is unmuted, so if he wants to jump in, he can jump in.
We're waiting to see if David wants to jump in.
All right, hold on. Let's see. No, he's not. So why don't you just go ahead and answer him?
There are a couple of FinTech-focused incubators and investors, just like there are, focused security and mobile app and whatever. And it's interesting. In my direct, I'm kind of going through my list of people that I know. If I could recommend you go to one person specific, who would it be? And so nothing's coming up right away, which is why I was being really quiet. I don't think you necessarily need FinTech-specific investors, because you could also, just on what little you said, you could be looking for SaaS investors, which is a lot bigger group. And SaaS investors, just like our earlier conversation about mobile investors, increasingly are looking at the same set of metrics to compare across the businesses. And you may not have those metrics yet, and that's okay, but I was just using this moment to say it's the same sales pitch as for mobile. It's like, what's your acquisition cost? What's the lifetime value? What's the monthly recurring revenue? What's the growth rate? Attrition, a very obvious set of marketing-oriented questions that help a lot in raising SaaS money. Side note, I've come much closer to investing in a SaaS company this year than I have investing in a mobile company this year. I've done neither. I've done hard technology deals so far.
Gadiel, anything to add?
I think a lot. Yeah, I think a lot is going to depend on the size of the check too, because I think if it's very early on, it very well may be just, it's a wider spectrum in terms of the industry and the types of companies that investors want to look at. But if you're going for an A round, then yeah, you can start to kind of narrow into more of a FinTech focus depending on the business. I mean, we could be talking virtual currency, we could be talking something in the banking space. I mean, it's really hard not knowing what space we're talking about.
And, it occurs to me that almost every financial institution that you would ever care about has some sort of outpost in Silicon Valley. I mean, this is the reason why we're in Silicon Valley, because people come here. So if you want to meet with, MasterCard obviously, but if you want to meet with Citibank or Visa or Bank of America, Capital One. I mean, every financial services business has somebody out here. who is an outpost, and some of them have formal programs for, giving small amounts of money to these groups. And so I think I might bark up that tree and see what's there.
Okay, great. And David's just saying he's having some problem with his audio. I've unmuted him, but for some reason he can't talk. So he just added that he's raised some funding, but just need a VC to get to the next level. So I mean, I think you've spoken to that. And David, I feel like I'm like a little facilitator here. David, just to let you know, we have someone else that's on in the audience today is one of our CFOs, and he wrote me to say he has a FinTech contact. So I'll actually make an introduction offline to David and Chris so that you guys can make that introduction to your FinTech contact. So look at how we're doing some matchmaking.
Yeah. That's the way I think the venture business should work, right? I mean, it would be boring for every person on the call for us to be providing specific help to everybody, but really the way it should work is we should be getting stuff done.
Yeah, I love it. I love it. This is great. Okay, I know, and I'm having my sort of days as a teacher are coming back to me. I see all these people in the audience not raising their hands, but they were interested enough to join us today. So I'm so tempted to just unmute someone and call them out and make them ask a question. But I will not do that.
Cold call Sally.
I'm really tempted. Okay, so just so you know, people, I'm not going to do that. But if you have a question, we still have some time here. So please enter your questions in or raise your hand, and we'd love to hear from you. In the meantime, Gadiel, I'm just wondering, like, you talk with our clients all the time who are in the process of fundraising. Do you have any questions you maybe want to put out to Sean that would be helpful for the audience to hear, that you just sort of, common questions, common holdups, or just things people want to know?
Yeah, at very early stages, one of the big questions we get is valuation and things around the valuation. Like, should I go in talking to a VC and have a valuation in mind for my company? And sometimes they confuse that with a 409A valuation, but other times it's just what am I looking at? Are there, baselines that I should consider as I'm having these conversations? Can you talk a little bit about that from your perspective?
Yeah, good. I'm glad you asked me a question I can answer. I thought this was going to be like stump the chump, right? But yeah, I'm glad to answer that. So, I have to divide it into two pieces. So there's increasingly convertible debt is an option. Didn't used to be nearly as much convertible debt 5 years ago as there is now. In convertible debt, the main discussion on valuation is what the cap of the valuation when it converts will be and what the discount will be on that cap. And again, depends on the size of the company. I think if you have a convertible debt instrument whose cap is above 10 million, you probably shouldn't be raising convertible debt. You're probably you should be thinking about a round. So typically I see convertible debt with a 15 to 25% discount on a cap of 4 to 8. I think probably 2/3 to 3/4 of everything I see falls into that range if you're in the convertible debt world. On the venture capital side, it's really interesting. The amount of money you raise actually affects what the valuation is. So a Series A, it used to be a Series A was a 5 million pre-raising 3. Now it seems like Series A's are getting quite a bit larger. I really think actually we've had series inflation. So today's Series A is really what a Series B used to be, and people have introduced new language for what a Series A would be called like Series Seed. Those things are single-digit pre-money valuation, and you really want to be selling 25% to 1/3 of your company, or I should put it slightly differently. You should be issuing shares, which will, after the deal is done, account for 25% to 33% of the company. And so I kind of look at it that way. I think that entrepreneurs get really caught up on what the valuation should be, that they want a big number for ego or to reduce the valuation. Again, there's a couple of issues. So one thing is you don't want to sell too much of your company. So you need the valuation high enough that you're not selling half the company in your seed round, right? You need to be thinking, I'm doing multiple rounds of funding, I'm playing this game multiple times, and at the end, management as a whole of a public company needs to own 20% of a public company. You've done really well if that's the case. Pandora, they owned like 12%. That wasn't so good. Company went sideways. other companies own more. But I think a good target is you should model out to own 25% by the end if you're a public company. And therefore, if you sell 25 to 33% through 3 or 4 rounds of financing, that works out okay, and you end up just fine. So that drives a lot of what I think the valuation should be. How much do you need, and how far along are you? In the end, it's a real estate business. It's like, most importantly, I don't think an entrepreneur should be trying to set the valuation by, you don't know the market as well as the people on the opposite side of the table. So you don't want to scare people off by picking a big number or leave money on the table by picking a small number. You wait until the VCs give you a number, and then you talk to all your other VC contacts and say, hey, somebody just offered me 9 million pre, can you give me 12? And you can kind of play us against each other. Importantly, I saw an episode of Silicon Valley, which I don't know if anybody else has watched it. I don't know whether it's a good show or a bad show. I think it's actually a little too close to home. It's a little bit like I'm working, like I'm sitting in a conference room, like dealing with these issues instead of watching entertainment. But there was this Silicon Valley episode where the debate was they just went out to try to get the highest valuation they could get, and it got higher and higher and higher. The problem becomes if you have a high valuation now and the next round is lower or not significantly above the last one, you've screwed up the company. It makes it harder to raise the next round. Your existing investors are pissed off. It shows negative momentum. So you don't want to get ahead of yourself on that valuation number as well. So it's not just the I want the highest possible. I'm selling a car and I want to sell it for the absolute most I can. It's more like oh crap. Now I need an analogy. It's a multiple prisoner's dilemma, right? Single prisoner's dilemma. Screw you. I want the best deal, and you're screwed. But if you play prisoner's dilemma lots of times, you start wanting to get to the circle where both sides end up making money. Wow, that was a long answer.
It was a great answer.
How are we doing, Erica?
We're doing okay. I'm looking through. I'm going to give the countdown here. Speak now or hold your peace, not forever, but at least for this month. But we will have another follow-up to this because I think this is a great forum. I think it works really well, and I think people appreciate the opportunity to get real answers to their real questions. So, yeah.
I think it might be, one, some people may be shy. Look, it's like, I don't know, you guys may talk to VCs all day long, but this is a chance to talk to a VC, and not that we're necessarily great people. It's just I know that it's hard to get access. It's hard to get insight, and it might be that people are shy, or it might be that people have specific questions that seem too specific for a big group. Mm-hmm. But we've got a few minutes left, so let's hear a specific question, and we can turn it into a general answer if we want to.
So that's a call to
really
you.
Quick. Just
yeah. Go ahead, Gadiel. Sorry.
I've got just one more follow-up for Sean. Sean, are you seeing more safe agreements versus convertible notes? The safe agreements?
Well, it's interesting. No, I don't see a lot more safe agreements. Is the direct answer. The slightly more general answer is the difference between them is really slight in my book. I do some convertible debt. I do some rounds. So we've been split in this pre-A fund, but between the two. I got to tell you, so let's talk about convertible debt for a second because it's a huge business right now. A lot of people are using convertible debt. The entrepreneurial advantages are you can have a rolling close, it's low cost and legal, right? Those are two great things that work in favor of doing a convertible note. The bad things about doing a convertible note is if whatever the eventual valuation is, if it's below the cap or anything like that comes entirely out of your hide. If I had done a round with you at a 10 million pre and then we ended up doing a round at an 8 million pre, I get punished just as much as you do. If it's a convertible note, you get 100% punished and I don't. The other thing, which is kind of minor that I don't like about convertible notes, is people are now stringing convertible notes along for 3 or 4 years. My investors have specific tax treatment. So you can roll over capital gains if you have them for more than 5 years in a small business. And if you spent 3 of those 5 years in a convertible note, I can't, the clock on that doesn't start until you eventually raise a round. So increasingly, I don't want to do $3 million worth of convertible notes. I need to have the equity so that whenever we get to an eventual exit, my investors are not going to have to pay the highest possible tax bracket. They can pay a lower tax bracket. So, I mean, that's worth 10, 20% of the total returns of the deal. That's a big deal. So anyway, I understand the advantages of convertible debt. I think we're overusing it right now. Oh, also the advantage of convertible debt is you don't have any terms. Like, you can't be fired. There's no board, right? I mean, it's like a lot of freedom as an entrepreneur. But I think that the pendulum is going to start swinging, and people are going to, start pushing for more rounds versus convertible notes over the next couple of years.
Great, thanks. And if people want to know more about convertible notes, it's actually a topic that we get a lot of questions about. And so we've done a couple of webinars recently on convertible notes, including a Q&A. So you can go check out our YouTube channel and our blog if you want to read some content and hear some recordings we've done on convertible notes. I think that actually takes us to the end of the hour here, and we don't have any outstanding questions right now. We have our contact information up here, so it may be that folks are thinking about reaching out to us individually with their own questions. You're welcome to do that. As I said, we'll also be scheduling a follow-up. We're going to do these kind of regularly because we think it works and it's fun, so why not? You're all on our mailing list, so stay tuned for upcoming Ask the VC webinars and other webinars we have, and feel free to join. Just a quick plug that we do have another webinar coming up on July 16th with Paul Slazak from Recruit Loop, and that's going to be on hiring strategies for small businesses and really tactical advice on things like interviewing and creating a job ad and all those things to help you to hire the best talent for your company. So you can go to our website to check out all of our upcoming events and sign up for these and others. So thank you, Sean, and thank you, Gadiel, and thank you everyone who was brave enough to raise your hand and ask your questions, and hope you found this useful. Thanks, guys.
Thank you.
Okay, take care. Okay, bye-bye. Have a great day, everyone.